Question 1. An individual holds a Connecticut life insurance license but is not appointed by any insurer. Which of the following activities is this individual prohibited from performing? A. Attending continuing education courses to maintain their license. B. Submitting an application for an insurance policy to an insurer. C. Discussing general insurance product features with a potential client. D. Receiving commissions from an insurer for previously placed policies. Answer: B. Submitting an application for an insurance policy to an insurer. In Connecticut, an insurance producer must be appointed by an insurer to act as an agent of that insurer, which includes soliciting or submitting applications for policies. While a licensed producer can discuss general product features, attend continuing education, or receive residual commissions from past, properly appointed sales, they cannot legally bind an insurer or submit new business without a current appointment. This requirement ensures that an insurer is responsible for the actions of its agents when they are selling on its behalf. Always remember that licensure allows you to be an insurance professional, but an appointment allows you to sell for a specific company. Question 2. A variable life insurance policy owner in Connecticut requests to surrender their policy. What is the maximum number of days the insurer has to pay the cash surrender value from the date of the request? A. 7 days. B. 30 days. C. 60 days. D. 90 days. Answer: A. 7 days. For variable life insurance policies in Connecticut, the insurer must pay the cash surrender value within a maximum of 7 days after the policy owner submits the request. This specific, shorter timeframe for variable policies compared to traditional life policies is due to the nature of variable products, where the cash value fluctuates based on underlying investment performance, and delaying payment could significantly impact its value. This regulation protects policy owners from market fluctuations and ensures prompt access to their funds. Remember this stricter deadline for variable products. Question 3. Under a participating whole life insurance policy in Connecticut, which of the following is an accurate description of a dividend? A. A guaranteed payment to policy owners at the end of each policy year. B. A return of unearned premium, typically paid annually, that is not taxable as income. C. The interest credited to the policy's cash value, subject to taxation. D. A distribution of the insurer's profits to policy owners, always considered taxable income. Answer: B. A return of unearned premium, typically paid annually, that is not taxable as income. Dividends from participating life insurance policies are considered a return of an overpayment of premium, not taxable income. They are typically paid annually and reflect the insurer's favorable experience regarding mortality, expenses, and investments. While not guaranteed, they are a unique feature of participating policies that allow policyholders to share in the company's surplus. Think of it like getting a refund on something you overpaid for, rather than earning new income. Question 4. An insurer in Connecticut must include which of the following statements on its policy forms if it markets universal life insurance? A. The guaranteed interest rate will not fall below 4%. B. The policy cash value may increase or decrease based on investment performance. C. Premiums are flexible, but policy lapse may occur if insufficient cash value exists to cover charges. D. No additional premiums are required after 10 years. Answer: C. Premiums are flexible, but policy lapse may occur if insufficient cash value exists to cover charges. Connecticut regulations require universal life insurance policies to clearly state that while premiums are flexible, the policy's continuation depends on having sufficient cash value to cover policy charges, and insufficient funds can lead to lapse. This disclosure is crucial because universal life policies allow policy owners to vary their premium payments, and they need to understand the potential consequence if their cash value diminishes. This ensures transparency about the policy's long-term financial stability. Always emphasize the importance of understanding the policy's mechanics, especially with flexible premium products. Question 5. In Connecticut, if a life insurance policy is replaced, what is the minimum free look period for the new policy? A. 10 days. B. 20 days. C. 30 days. D. 45 days. Answer: B. 20 days. When a new life insurance policy replaces an existing one in Connecticut, the minimum free look period for the new policy is extended to 20 days. This extended period, compared to the standard 10-day free look for non-replacement policies, provides the policy owner with additional time to review the new policy and decide if the replacement is truly in their best interest, given the potential disadvantages of replacement. This consumer protection measure helps to mitigate the risks associated with twisting, an unethical practice of inducing policy replacement for the sole purpose of generating new commissions. Always advise clients to carefully consider all implications before replacing an existing policy. Question 6. A life insurance policy in Connecticut includes a suicide clause. If the insured commits suicide 18 months after the policy's effective date, how would the insurer typically handle the claim? A. The insurer would pay the full death benefit. B. The insurer would refund the premiums paid, without interest. C. The insurer would pay the cash value of the policy, if any. D. The insurer would deny the claim entirely. Answer: B. The insurer would refund the premiums paid, without interest. In Connecticut, the standard suicide clause in a life insurance policy states that if the insured commits suicide within 2 years, 24 months, of the policy's issue date, the insurer's liability is limited to a refund of the premiums paid. Since 18 months falls within this 2-year period, the insurer would only return the premiums. If the suicide occurs after the 2-year period, the full death benefit would be paid. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide shortly thereafter. Always remember that the suicide clause has a specific time limit to be effective. Question 7. All of the following are examples of unfair trade practices in Connecticut except A. Twisting, which involves inducing an insured to drop an existing policy for a new one without benefit. B. Rebating, which involves offering a portion of the premium or commission as an inducement to purchase. C. Coercion, which involves using intimidation to secure insurance business. D. Sharing commissions with a licensed producer from another state who is also licensed in Connecticut. Answer: D. Sharing commissions with a licensed producer from another state who is also licensed in Connecticut. Sharing commissions with another licensed producer is generally permissible in Connecticut, provided both producers are properly licensed for the lines of authority involved and, if applicable, appointed. The other options, twisting, rebating, and coercion, are all strictly prohibited unfair trade practices designed to protect consumers from manipulative or unfair sales tactics. Producers must always conduct business ethically and avoid practices that could harm the public or distort competition. Remember that lawful collaboration between licensed professionals is distinct from unfair or prohibited business practices. Question 8. Under Connecticut law, what is the primary purpose of the Connecticut Life and Health Insurance Guaranty Association? A. To regulate insurance companies operating within the state. B. To provide financial relief to policy owners of insolvent insurers. C. To resolve disputes between policyholders and insurance companies. D. To administer licensing exams for insurance producers. Answer: B. To provide financial relief to policy owners of insolvent insurers. The primary purpose of the Connecticut Life and Health Insurance Guaranty Association is to protect resident policy owners and beneficiaries against financial loss in the event a member insurer becomes insolvent and cannot meet its contractual obligations. The association steps in to pay covered claims up to certain limits, funded by assessments on other solvent insurers. This acts as a safety net, ensuring that policyholders are not left without coverage due to an insurer's financial failure. Think of it as a consumer protection mechanism designed to maintain confidence in the insurance industry. Question 9. Which of the following statements accurately describes the entire contract provision in a Connecticut life insurance policy? A. The policy owner can change the policy terms by signing a new agreement with the insurer. B. The policy document, the application, if attached, and any riders constitute the entire contract between the parties. C. The insurer can modify the policy unilaterally at any time if market conditions change. D. Any oral agreements made by the producer during the sales process are legally binding components of the contract. Answer: B. The policy document, the application, if attached, and any riders constitute the entire contract between the parties. The entire contract provision in a Connecticut life insurance policy, like in most states, states that the policy itself, along with the attached application and any riders or amendments, form the complete and exclusive agreement between the insurer and the policy owner. This provision is vital because it prevents either party from introducing extrinsic evidence or prior oral agreements to alter or contradict the written terms of the policy, ensuring clarity and preventing disputes. It also means that statements made on the application, even if not physically present in the delivered policy, can be considered part of the contract if properly attached. Always remember that what's written down is what counts. Question 10. A Connecticut resident applies for a life insurance policy and makes a material misrepresentation on the application. The insurer discovers this misrepresentation 3 years after the policy was issued. What is the likely outcome regarding the policy's validity? A. The insurer can rescind the policy due to material misrepresentation. B. The insurer must pay the death benefit if the insured dies, as the incontestability period has passed. C. The insurer can adjust the policy's face amount to reflect the correct information. D. The insurer can cancel the policy and refund all premiums paid. Answer: B. The insurer must pay the death benefit if the insured dies, as the incontestability period has passed. The incontestability clause in Connecticut life insurance policies, like most states, typically limits the insurer's ability to contest the policy's validity due to misrepresentation or concealment after a specific period, usually 2 years from the issue date. Since the misrepresentation was discovered 3 years after issuance, the 2-year contestability period has passed, meaning the insurer cannot deny a death claim based on that misrepresentation. This clause protects policy owners from having their coverage revoked years after it was issued, promoting policy stability. Remember that after 2 years, the policy is generally incontestable regarding initial statements, protecting beneficiaries. Question 11. An advertisement for a life insurance policy in Connecticut must not contain language that implies: A. The policy will pay a guaranteed interest rate. B. The policy is equivalent to a bank deposit. C. The policy offers flexible premium payments. D. The policy's cash value is tax-deferred. Answer: B. The policy is equivalent to a bank deposit. Connecticut regulations, like those in many states, strictly prohibit life insurance advertisements from implying that an insurance policy is equivalent to a bank deposit or other savings institution product. This is because insurance policies, particularly those with cash values, carry different features, guarantees, and risks than bank deposits, which are typically FDIC insured. Misrepresenting an insurance policy as a bank deposit would be considered misleading advertising. Producers must always ensure their marketing materials accurately represent the nature and benefits of insurance products without making false comparisons. Question 12. A Connecticut licensed producer offers a prospective client a free vacation package as an inducement to purchase a life insurance policy. This action is an example of A. Unfair discrimination. B. Defamation. C. Rebating. D. Coercion. Answer: C. Rebating. Offering a free vacation package as an inducement to purchase a life insurance policy constitutes rebating, which is an illegal practice in Connecticut. Rebating involves offering something of value not specified in the insurance contract as an incentive to buy a policy. This practice is prohibited because it can lead to unfair competition among producers and may compromise the integrity of the insurance transaction by focusing on inducements rather than the policy's suitability. Remember that all considerations for the policy must be explicitly stated within the policy contract itself. Question 13. Which statement regarding the grace period for a life insurance policy in Connecticut is most accurate? A. It is typically 10 days, during which the policy remains in force without premium payment. B. It is a period, usually 31 days, after the premium due date, during which the policy remains in force. C. It allows the policy owner to surrender the policy for its cash value without penalty. D. It applies only to variable life policies and is 7 days in length. Answer: B. It is a period, usually 31 days, after the premium due date, during which the policy remains in force. In Connecticut, as in most states, a life insurance policy typically includes a grace period of 31 days after the premium due date. During this grace period, the policy remains in full force, meaning coverage continues even if the premium hasn't been paid. If the insured dies during this period, the death benefit would still be paid, usually with the overdue premium deducted. This provision provides a safety net for policyholders who might accidentally miss a premium payment, preventing immediate policy lapse. The grace period ensures policyholders have time to rectify an oversight without losing their valuable coverage. Question 14. What is the primary reason for a life insurance policy's misstatement of age or sex provision in Connecticut? A. To allow the insurer to deny a claim if the insured's age or sex was incorrect. B. To prevent the policy from lapsing if the incorrect age or sex was used. C. To adjust the death benefit or premiums to reflect the correct age or sex of the insured. D. To require the policy owner to purchase an additional rider for correct coverage. Answer: C. To adjust the death benefit or premiums to reflect the correct age or sex of the insured. The misstatement of age or sex provision in a Connecticut life insurance policy ensures that if the insured's age or sex was incorrectly stated on the application, the insurer will adjust the death benefit or premiums to what they would have been had the correct information been provided. This provision prevents policy voidance due to an innocent misstatement, instead ensuring the contractual exchange remains fair based on the actual risk presented. This clause protects both the insurer from undercharging for risk and the policy owner from losing coverage entirely due to a simple error. Question 15. A Connecticut resident applies for a life insurance policy. The producer provides a copy of the application to the applicant at the time of application. What is the purpose of this action? A. It satisfies the disclosure requirements for replacement policies. B. It allows the applicant to review the information and correct any errors. C. It is required only for group life insurance policies. D. It provides immediate proof of coverage to the applicant. Answer: B. It allows the applicant to review the information and correct any errors. Providing the applicant with a copy of the application at the time of application allows them to review the information they provided and identify any errors or omissions immediately. This practice promotes accuracy in the application process and helps prevent future disputes related to misrepresentations. While it contributes to good disclosure, its primary immediate benefit is allowing for self-correction. Remember that accurate application data is crucial for proper underwriting and future claim processing. Question 16. If a life insurance policy in Connecticut is issued with a conditional receipt, coverage typically begins when: A. On the date the policy is delivered to the insured. B. On the date the first premium is paid and the application is approved by the insurer's underwriter. C. On the date the application is signed, regardless of premium payment. D. After the free look period has expired. Answer: B. On the date the first premium is paid and the application is approved by the insurer's underwriter. A conditional receipt in Connecticut indicates that coverage may begin on the date the application was signed and the initial premium was paid, provided that the applicant is found insurable and the policy is approved by the insurer's underwriting department as applied for. If the applicant is not approved or is approved with modifications they don't accept, coverage never begins. This provides temporary coverage while the insurer processes the application, giving the applicant peace of mind. Think of it as conditional coverage, dependent on the insurer's final approval. Question 17. Which of the following statements about the automatic premium loan provision in a Connecticut life insurance policy is true? A. It is mandatory and automatically included in all whole life policies. B. It prevents a policy from lapsing due to unpaid premiums by borrowing from the cash value. C. It can only be used if the policy owner has a pre-existing loan against the policy. D. It requires additional premium payments to activate. Answer: B. It prevents a policy from lapsing due to unpaid premiums by borrowing from the cash value. The automatic premium loan provision is an optional rider in a life insurance policy that, if elected, allows the insurer to automatically borrow from the policy's cash value to pay an overdue premium, thereby preventing the policy from lapsing. This feature acts as a safety net, ensuring the policy remains in force even if the policy owner forgets or is unable to pay a premium. While useful, it's important to remember that these are loans against the cash value and accrue interest, potentially reducing the death benefit if not repaid. This provision offers a valuable layer of protection against unintentional lapse. Question 18. Under Connecticut law, what is required if a producer is replacing a customer's existing life insurance policy? A. The producer must obtain the customer's signature on a replacement notice. B. The producer must notify the existing insurer only if the new policy has a lower face amount. C. The producer must immediately pay the first premium for the new policy. D. The producer must guarantee the new policy will offer better terms than the old policy. Answer: A. The producer must obtain the customer's signature on a replacement notice. In Connecticut, when replacing a life insurance policy, the producer is required to present the applicant with a notice regarding replacement of life insurance, have the applicant sign it, and provide them with a copy. This notice is a crucial consumer protection measure designed to inform the policyholder of the potential disadvantages of replacement, such as new contestability periods, higher premiums due to age, or lost benefits, helping them make an informed decision. This process ensures transparency and discourages twisting. Always prioritize full disclosure when a replacement is considered. Question 19. A Connecticut life insurance policy owner wants to assign their policy to a bank as collateral for a loan. This type of assignment is known as A. Absolute assignment. B. Collateral assignment. C. Testamentary assignment. D. Revocable assignment. Answer: B. Collateral assignment. When a life insurance policy is assigned to a bank as security for a loan, it is known as a collateral assignment. In a collateral assignment, only a portion of the policy's rights or values are transferred to the assignee, the bank, specifically enough to cover the outstanding loan balance. The policy owner retains all other rights and any proceeds exceeding the loan amount. An absolute assignment, in contrast, transfers all ownership rights permanently to another party. Collateral assignments are common for securing various types of loans. Question 20. Which of the following is not a characteristic of a qualified plan under Connecticut and federal tax law? A. It must be approved by the IRS. B. Contributions are typically tax-deductible. C. Distributions are always tax-free. D. Earnings grow tax-deferred. Answer: C. Distributions are always tax-free. Distributions from qualified plans are generally taxable upon withdrawal, as contributions are often made on a pre-tax basis and earnings grow tax-deferred. While some distributions, like Roth IRA qualified distributions, can be tax-free, it is not a characteristic of all qualified plans. Qualified plans, such as 401(k), S and IRAs, receive favorable tax treatment because they meet specific IRS requirements regarding non-discrimination, vesting, and reporting, which includes tax-deductible contributions and tax-deferred growth. Always remember that tax advantages often come with conditions on withdrawals. Question 21. According to Connecticut law, what is the maximum interest rate an insurer can charge on a policy loan against the cash value of a life insurance policy? A. 6% fixed, or a variable rate tied to an index, not to exceed a specific cap. B. 8% fixed, or a variable rate tied to an index, not to exceed a specific cap. C. 10% fixed, or a variable rate tied to an index, not to exceed a specific cap. D. The interest rate is not regulated by state law. Answer: B. 8% fixed, or a variable rate tied to an index, not to exceed a specific cap. Connecticut law specifies that the interest rate on life insurance policy loans cannot exceed a fixed rate of 8% per annum. Alternatively, the insurer may use a variable interest rate, provided it is tied to a recognized index and subject to certain limitations and disclosures. This regulation is in place to protect policy owners from excessive charges when borrowing against their own cash values, ensuring that loans remain a viable and affordable option. Remember that policy loans are borrowing from yourself, and their interest rates are regulated for consumer protection. Question 22. When a Connecticut life insurance policy owner reinstates a lapsed policy, what typically happens regarding the incontestability period? A. The original incontestability period continues from the policy's issue date. B. A new incontestability period begins from the reinstatement date. C. The policy becomes immediately incontestable upon reinstatement. D. The incontestability period is extended by the length of time the policy was lapsed. Answer: B. A new incontestability period begins from the reinstatement date. When a lapsed life insurance policy is reinstated in Connecticut, a new incontestability period typically begins from the effective date of reinstatement, usually for a period of 2 years. This is because the insured must provide evidence of insurability to reinstate the policy, essentially undergoing a new underwriting process. The new contestability period allows the insurer to review the accuracy of the new information provided during reinstatement. It's crucial for policy owners to understand this implication of reinstatement. Question 23. A Connecticut insurance producer receives a complaint from a policyholder. How long must the producer retain records of all complaints received? A. At least 1 year. B. At least 3 years. C. At least 5 years. D. At least 7 years. Answer: C. At least 5 years. In Connecticut, insurance producers are required to maintain records of all complaints received for a minimum of 5 years. This requirement allows regulatory authorities to review a producer's business practices and complaint handling procedures if necessary, ensuring compliance with state laws and consumer protection. Maintaining accurate records is a fundamental aspect of professional conduct and regulatory compliance for all licensed producers. Always remember the 5-year rule for complaint retention. Question 24. What is the primary purpose of the Connecticut Insurance Department's regulation regarding suitability for annuity sales? A. To ensure all annuity sales maximize the producer's commission. B. To require producers to recommend the lowest cost annuity product to all clients. C. To ensure that the annuity product recommended is appropriate for the consumer's financial situation and objectives. D. To guarantee specific investment returns for annuity purchasers. Answer: C. To ensure that the annuity product recommended is appropriate for the consumer's financial situation and objectives. The primary purpose of suitability regulations for annuity sales in Connecticut is to ensure that producers recommend annuity products that are appropriate for the consumer's financial situation, insurance needs, and investment objectives. This means considering factors like the client's age, income, existing assets, risk tolerance, and liquidity needs. The regulation aims to protect consumers from being sold products that are not aligned with their best interests, even if they might offer high commissions. Suitability is about putting the client's needs first. Question 25. Under Connecticut law, which of the following best describes the regulation of advertising for life insurance policies? A. All advertisements must be pre-approved by the insurance department. B. Advertisements must be truthful and not misleading, with insurers responsible for their content. C. Producers are exempt from advertising regulations if they only use insurer-provided materials. D. Advertising is only regulated for variable life insurance products. Answer: B. Advertisements must be truthful and not misleading, with insurers responsible for their content. In Connecticut, as in most states, life insurance advertising is heavily regulated to ensure it is truthful, accurate, and not misleading. While pre-approval by the insurance department is not always required for every single ad, insurers are ultimately responsible for the content of their advertising and must ensure compliance with all applicable regulations. This prevents deceptive practices and ensures consumers receive accurate information about policy benefits and limitations. Always remember that transparency and honesty are paramount in all insurance communications.